All right, Sunday, October 16th. And for those of you who are watching right now, wondering if I'm going to talk about last Thursday's weird price action, I will. But let's go in order here so that we have a foundation to understand whether or not we believe what happened last week. Have a look at our rates. Look across the top here. Every single one, from your money market rates to your capital market rates, hit year-to-date highs either on Thursday, which was the 1 month, or Friday, closed on Friday at the highest of the year. All of them. Next FOMC meeting is November 2nd. That is in 17 days. We're going to review the September minutes from the Fed shortly because there are some things that we need to review first so that when we read the minutes, we can put that in context and see if it means anything to us. Our 2 to 10 slope is inverted still. It's been 102 days now, kind of hanging around the 50 basis point mark, bouncing between down 30 and down 50, but 102 days now. Fed balance sheet ending October 12th dropped 4.05 billion. All of them were T-bills. So we're sitting at 8.2 trillion on the balance sheet versus 8.27. This is ending October 12th. Treasuries mature on the 15th and I think the 30th of the month. So the big drawdown in treasuries will be the 15th and the 30th. And MBS has payments once a month, so all of those come in at one point in time, and the balance sheet will drop by the amount of whatever principal and prepayment amounts are received. The MBS is rolling off slower than the cap. The cap is 35 billion. It's not going to hit the cap. It's somewhere around 20 billion. So treasuries are hitting the cap of 60 billion, MBS at 20. So we got about $80 billion runoff per month. You got another 160 from November and December. I don't think we're going to see a 7 handle before the end of the year on the Fed balance sheet. Last week, look at what happened in rates. Or the expectation for a rate increase in November 2nd. That's in 17 days, by the way. And then 6 days after that, you have the midterms. So you have November 2nd. Then November 4th, you have payrolls from the month of October. And then the following Tuesday, you have the midterms. So there's a lot of risk events happening right at the beginning of November. And before we even get there, we got 2 weeks of heavy earnings coming up. So there's a lot of data that's going to be coming in. For the November 2nd rate hike last week, there was only a 20.4% probability of 50 basis points, 80% of 75. That's now at 98%. It ended the week this way, 98% at 75 and 2% at 50. On the 13th, it was basically the 50 was gone altogether, and there was a small probability, I think around a little under 5%, somewhere around, it was under 5%, a small probability of 100 basis points, with the weight of it being on the 75. By the time we ended on Friday, the 100 had disappeared. There was either a 50 or a 75 and 2% on the 50. Year end has changed quite a bit. 4.25 is almost non-existent, 0.6%. It was 14.5%. 4.5% has a 31.3% probability, was a 62. The weight has moved to the 4.75. Almost a 70% probability at 4.75, 23% the week before. So I had always been thinking that the November 2nd, I didn't have a compelling reason for 75, so I thought, well, 50 seems like the way to go. You've just had 3 75s. You should let some things catch up for a while, and 50 and 25 seems reasonable, and then that seems like a good place to stop. But I seem to think that given what we've had on the CPI report, 75 seems more probable. However, next week we have 5 Fed speakers. This will be the first real voice we're getting from the Fed post-CPI. So now that they know that number, what is their tone? Are they going to be talking just as aggressively and even more aggressively? Are they going to signal that that the rates are probably going higher than what the market implies and staying higher longer than the market implies? Let's hear what they have to say. But it seems that if we look at November being 75 basis points, that is probably correct from based on the information that we have right now. Okay, real yields, none of them hit new highs last week. We still have the September 30th highs in place on the real yields. Break-even rates all increased. And on Friday with the Michigan, the consumer sentiment report, you also get the 5-year inflation expectations came in at 2.9 versus 2.7. I mention this because when we get to the minutes, they do talk about inflation expectations, how important it is for them to make sure that inflation expectations are well anchored. Well, all the break-even rates increased, and this has increased as well, 2.9 versus 2.7. If you are an individual that expects higher inflation in the future, that is going to affect decisions that you make about what you're going to buy and how you're going to negotiate the next salary raise. That if you expect there to be higher inflation, you're going to build that into what you ask. So you have to get that expectation to move in the other direction. This is interesting. We have the wage growth tracker from the Atlanta Fed, and I've got 3 months of data up here. This is the most recent month. We've already had the September jobs report from August, and this is the wage growth overall, 6.3%. 6.7 in August, 6.7 in July, so it's come down during the month of September. That wasn't reflected in CPI, but 6.7 to 6.3. If we look at job stayers, they're down to 5.3. 5.9 in July, 5.6 in August, down to 5.3 in September, so that's going in the right direction. Job switchers, 8.5 in July, 8.4 in August, down to 7.9 in September. So those are heading in the right direction, although they are elevated. We can see that it is moderating. For weekly unemployment claims or initial jobless claims, going from September 10th, 2008, next week was 2009, then it dropped to 190. October 1st was 219, now we're at 228. I said let's watch that 300K level, because at 300K, if you get to there for 4 weeks in a row, your 4-week average probably is going to show job losses on a job report. You'd need 4 weeks of that to happen. And last week I mentioned economists tend to think it's about 275 for 4 weeks would create zero job growth. 300, I move it to 300 just, if you're at 3 each week and they think it's 275, then you're really certain, right? But we are going in the right direction from 190 to 219 to 228. So let's keep watching this number and let's see if that 228 goes to 235, goes to 242 and starts climbing up. That would give us more faith that this would continue to decline because you're introducing more slack into the labor market. And if you can get these job switchers to say, you know what, given what's going on right now, I think I will just stay put. Okay, let's look at credit spreads. The OAS, October 13th, investment grade, 1.71. That was the same high for October 12th. October 12th, October 13th, say at 1.71. We don't have October 14th data yet. As for the rest of them, the July 5th highs on the yield or on the spread still hold for CCC. September 30th still has the high at 12.89. But again, we don't have Friday, and we are only 15 basis points below that level, and we did have a sell-off on Friday. 30-year fixed, 7.16. So I went to Fred and I said, called up the chart for the 30-year fixed to see when was the last time we had 7.16. Early 2002. Even during the housing bust of 2007 to 2009, mortgage rates never hit that level. But to be fair, the Fed was dropping rates during that period of time. So mortgage rates were sitting just below 7% during that period of time. However, the amount that you would say is due to the credit risk of being in a mortgage was probably much bigger then than what it is now, because a lot of this 7.16 is made up of the initial treasury yield anyways. If you look at the 10-year treasury at 4%, this is 3.16 or 316 basis points above the 10-year. Back in great financial crisis, that spread was much higher over the 10-year. So there's less perceived credit risk in the mortgage market now than there was then, even though we have a mortgage rate that's the highest since early 2002. FHA mortgages at 6.62 versus 6.14 the week before. This was 6.89 the week before. Mortgage applications. And, I don't know that there's a lot of information left in the week-to-week changes. You have such a low base right now that, any change in mortgage applications makes it look like it's a big number. So you're getting these high volatility week-over-week changes only because it's such a small index number at this point that I think it's probably better to look at it on a year-over-year basis. To determine, when is this going to turn around? When are we going to start seeing down 80%, down 75, down 70, down 65? That's signaling, stability and maybe some recovery in the mortgage market. Refi is down 86% year over year. This is for the same week. We're comparing, a 1 week period this year over the same 1 week period last year, down 86%. You're not refinancing your mortgage on the way up unless you have to, right? Purchases down almost 40%, 39% year over year. And this week we get some housing market data. National Association of Home Builders, the Housing Market Index. This is a diffusion index. Anything over 50 is expansion, under 50 is contraction. I don't think that any of us are expecting it to come in expansion mode. I think we do expect it to be in contraction. We're also going to get building permits this week, housing starts, and existing home sales. Here are yields. These were the OAS. So if we actually look at the yields on bonds, this is what they're showing right now. And I've heard some commentators on Bloomberg, some guests on Bloomberg suggesting that at 6%, that's kind of a nice place to hide until the uncertainty in the equity markets are over, or until at least the Fed is done raising rates and equities have found a bottom that you can get a 6% yield over that period of time. But you can also get 6% yields in very beaten up sectors of the economy. And we'll look at a couple in a second. There are some REITs, and REITs have really been destroyed because REITs have two big sensitivities. They have interest rate sensitivity, and they will behave like bonds. When interest rates go up, REITs price down. And they do have GDP sensitivity, so as we expect a slowdown in the economy, REITs will also sell off as well. This time in the cycle is a little bit different because there are a couple of REIT categories that have almost no vacancy rates. So apartments are a good example of one REIT category with almost no vacancy rates and about a 3 to 5 year cycle of rent resets higher. And what that means is if you have somebody in an apartment for a year and they decide to stay for another year, there's a limit to how much you can raise the rent for the next year. But if they move out and you replace it with someone, you can immediately mark that up to market rents right away. So when we look at, we're going to look at Realtor.com monthly rental trends, and we're going to see that rent has been decreasing for a couple of months. How come that's not showing up in the CPI report? If we look at rents over the last, let's say 3 years, you would see a trend that looks like this. But over the last couple of months, the rents have been decreasing. So rent per month, the average or national average of rent per month has been turning over. However, if you have a tenant from 3 years ago that stayed in the apartment, their rents were increasing at some fixed rate, whether it be 4% per year, but there's a limit to how much you can reset the rent if they're renewing. In Ontario, in Canada here, it's 4% per year. At least I think they're back to 4%. It was frozen for a while where you could not increase your rents at all for those who were staying. So if this person moves out at this point in time, even though rents have been turning down, landlord can then reset it at significantly higher market rents. This is what is being captured, not this part over here. So I think, just sort of saying, well, I can get 6% over the next 2 years. Let's move into, let's find an ETF that tracks a 1 to 3 year corporate high grade, and let's sit in there for a while and get that yield. I think you can do better by looking at beaten up sectors. And right now in the REIT sector, the two biggest beaten up sectors, I think unjustifiably so, are residential REITs and industrial REITs. All right, the Fed minutes, we got this on Wednesday, and I've got some parts highlighted, and I always read some of the parts to you and then give some narration on that. Some of the highlighted parts are not important for what they say. So it's, we can read what they say, but that's not the point. The point for some of the things that I highlight is here is what they are talking about. They're talking about this, they're talking about that. They are aware of these things going on, just in case we think, the Fed's making a mistake. This is going on and this is going on in the world. Well, and we'll see in the minutes, they're aware of these things going on. All that information's on the table, and they're aware of it, and they're still making those decisions. So it's not as if they don't know something or that they're not aware that something is going on. So we want to highlight certain things just so that we are comfortable in knowing that they know what we know, so that we don't have to then sit around thinking, they don't know any of this stuff. They don't know that this is going on. They're not paying attention to this. They're not paying attention to that. So let's begin. The first section is developments in financial markets and open market operations. We don't have to worry about the developments in open market operations, but let's see what they are aware of here. U.S. financial conditions tightened over the period, largely reflecting, I love the way they say this, by the way, largely reflecting an upward revision in investors' outlook for the path of the policy rate. Later on, they specifically mention the Jackson Hole speech, but they're not saying, that financial conditions have tightened largely because we beat the crap out of investors in Jackson Hole. They're saying largely because reflecting an upward revision in investors' outlook for the path of the policy rate. It's a polite way of saying it. Treasury yields climbed substantially, with most of the upward move reflected in real yields. Now that's important. That you can have nominal yields rising, but it's the real yield specifically. It's the real yield that has a higher correlation with business investment than the nominal yield. So the higher real yields go, the more it shuts down investment in, let's say, CapEx or fixed business investment or even residential investment, building of new homes. And real yields have been going up quite substantially for the year. Equity prices initially rose amid second quarter earnings reports that were better than feared. And I love the way they word this. They're not taking any responsibility for that July FOMC press conference at all having anything to do with the rally, right? Better than feared, but later retraced those gains in response to shifting policy outlook. So the rally was because of second quarter earnings. It wasn't because of anything we said. Love that. Regarding international developments, yields in most advanced foreign economies also rose sharply as a number of other central banks lifted policy rates and indicated their communications that they would likely continue to tighten monetary policy in order to address inflation pressures. The exchange value of the dollar appreciated notably, reaching multi-decade highs in real terms as market participants perceived mounting economic challenges abroad. So they are aware that all central banks are raising rates. Because I've heard that, the Fed has to understand that everybody's tightening around the world. They do. They do understand it. The Fed has to understand that the dollar is killing other economies. They do. They do understand it. They are mentioning it. The market implied path of the federal funds rate shifted sharply higher after market participants interpreted Federal Reserve communications, particularly those provided at the Jackson Hole Symposium. Well, at least they're tipping their hat to that, but they're not taking any blame for that rally. Beautiful. In addition, the market implied path suggested reasonable odds of additional 75 basis point and 50 basis point rate increases at the November and December meetings, respectively. Market participants generally anticipated a further slowing in the pace of rate increases after December, with the peak policy rate being reached in the first half of 2023. Now that's still there, the peak being reached in the first half of 2023, but it's peaking higher than it was before. We do not have equal odds of 75 and 50 in November any longer. It is predominantly on the 75. So we know that the market has opened the door to 75. If earnings don't change that, if going into that Fed meeting the market is still showing 75 and yields have already moved to reflect that, That's just the Fed filling a hole. They're more likely to go 75. I don't see the case for 100 yet. I just, not after 375s. To go 100, I think, would draw the anger of Congress way too much. So I think 75 would probably be pushing the limit of what they can defend in Congress. Desk survey respondents assigned an almost 30% probability to a decline in real GDP over 2022, nearly double the probability assigned in the July survey. So that would be 30% probability of a recession over the 2022 period. We are done third quarter. We're not going to see third quarter GDP, I think, until the end of next week. And then we'll get our first look at third quarter GDP and our last look at second quarter GDP. The markets for Treasury securities and agency MBS continue to function in an orderly manner, though liquidity conditions in both markets remained low, reflecting elevated interest rate uncertainty. So they are watching that. They are watching liquidity in both the Treasury and the MBS markets. They're saying they're functioning in an orderly manner. Liquidity is low, but, rate uncertainty is high. So what I take away from that is once they get closer to the end of the rate hiking cycle and the certainty increases about the path, liquidity will increase. So I don't know that they see this as something that they're going to step into and provide liquidity for. Amid strong demand for short-term investments, take-up at the overnight reverse repo agreement facility was relatively steady at elevated levels. They need very short-term T-bills because of interest rate uncertainty. They can't take on any duration when they're parking money overnight. So we saw on page 1 or screen 1, 4.05 billion in T-bills have run off. Well, that's 4.5 billion more that's available instead of going to the repo market. Repo market is still over 2 trillion. It's huge. It's going to take a long time to get that down. Issuance of short-term securities was likely to increase in coming periods, and as more clarity emerged in the economic and policy outlook, demand for short-term assets could moderate. Both of these developments would ease downward pressure on yields on safe short-term investments. So the question was, when we're looking at the 1-month Treasury, the 1-month T-bill, why is it lower than the Fed funds rate? Is because there's huge demand for it for those institutions, especially mutual funds that cannot access the Fed window or the overnight repo. There's huge demand for it. So what they're saying here is issuance of these short-term securities likely to increase in the coming periods, and that would ease downward pressure on yields on safe short-term securities so that those money market securities that we saw, the yields we saw, the 1 month, the 2 month, the 3 months, should increase. What else we got? There were no intervention operations in foreign currencies for the system's account during the intermeeting period, only because we are seeing other central banks intervene in the currency market. They felt it important to say at this point there were no interventions in foreign currency markets. This is the staff review of the economic situation now. The information available at the time of the September 2021 meeting suggested U.S. real GDP was increasing at a modest pace in the third quarter after having declined over the first half of the year. Labor demand remained strong, and the labor market continued to be very tight. Recent monthly readings indicated that consumer price inflation, as measured by the 12-month percentage change in the price index for personal consumption expenditures, remained elevated. This is September. These are the meetings from September. We've already seen October CPI for the month of September, and yes, it is elevated and higher than it was in September. Total PCE price inflation was 6.3% over the 12 months ending in July. Core PCE price inflation was 4.6% over the same period, and the trimmed mean measure, they're mentioning that here. So we know what they're looking at. They're looking at PCE, they're looking at core PCE, and they're paying attention to the trimmed mean measure of the 12-month PCE. This is from Federal Reserve Bank of Dallas. I've introduced that in previous market outlooks. Available spending indicators, including the August retail sales report, suggested that real PCE was on track to post a modest gain in the third quarter. Well, we did get retail sales from September We got that on Friday, so we'll have a look at that. But overall, headline with everything in, overall, 0%. 0% for September. However, the latest housing market data pointed to another sharp contraction in residential investment in the third quarter. And business fixed investment appeared to be rising at a tepid pace. Real goods exports stepped up in June and then rose further in July, led by increases in exports of industrial supplies. By contrast, real goods imports stepped down in June and then fell sharply in July, driven by a large decline in consumer goods imports. Exports and imports of services continue to be held back by an incomplete recovery of international travel. So that's giving you some look at the components of GDP. There are 4 components, right? Consumption, business investment, government expenditure, which I don't think they spend any time on government expenditure, and then the import-export. Net exports contributed positively to GDP growth in the second quarter and appeared on track to make another positive contribution in the third quarter. Weak foreign growth, a loss of momentum, and this is a sort of risks they're seeing. Weak foreign growth in recent months, a loss of momentum in the Chinese economy, increasing concerns about the property sector. Consumer price inflation rose further in August in many foreign economies, a continued broadening of inflationary pressure to core prices. Staff review of the financial system. So this was staff review of the economic situation. Now this is the financial situation. Credit remained widely available to most types of borrowers, but increases in borrowing costs appeared to damp the demand for credit in some markets in recent months. Well, the second part of that is just an obvious statement. You know, credit is more expensive. Hey, fewer people want it. Well, I mean, duh, right? But the first part is important. Credit remained widely available. So even with all these rate increases, they're looking at the credit markets and saying, look, there's no shortage of credit out there. It's not drying up. It's widely available. So something like this is not holding back their ability to raise rates even more. Treasury yields increased significantly across the maturity spectrum. The increase in nominal Treasury yields were primarily accounted for by rising real yields. We read that earlier, while inflation compensation measures declined substantially at short horizons and remain relatively little changed at medium and longer term horizons. They said that in September, but we just saw when we looked at the real yields and inflation expectations, the break-even rates, all the break-even rates have increased, and the 5-year inflation expectation from the Michigan Consumer Confidence Survey showed an increase month over month. And since they are pointing out that the inflation compensation measures declined here, well, now they've increased. Corporate bond spreads narrowed slightly on net and remain roughly at the midpoints of the historical distribution. Although secured overnight rates firmed slightly later in the intermeeting period, they remain soft relative to the reverse repo offering rate, a configuration that market participants attributed to relatively low Treasury bill supply, combined with strong investor demand for short-dated instruments amid uncertainty about the future path of the policy rate. Consistent with continued softness in purchase agreement rates, daily take-up in the overnight repo facility the overnight reverse repo facility remained elevated. So what we can take away from this is we have a dislocation on short-term rates, that some of those short-term rates are below the Fed policy rate because some people or some institutions can't access that window to get those rates. So there's a competition for whatever securities are available. But they do see that moderating as they roll off some of the T-bills, and as the Treasury issues more of those short-term securities, they would expect those money market rates to climb. What else do we have here? U.S. dollar appreciated further against most major currencies. Reaching multi-decade highs against the euro, the British pound, and the Japanese yen. The dollar strength largely reflected increasing investor concerns about the global growth outlook, as well as widening interest rate differentials between the United States and Japan. So they are aware of where the U.S. dollar happens to be. And in talking about it, they don't seem to bring in any risks. They're not saying, oh, but this is a risk or this is a concern. They don't seem to be concerned about the strength of the US dollar in this meeting. They just seem to note the strength of the US dollar and say the US dollar is strong, multi-decade highs, but it's a result of this and that. I don't see any concern here. In domestic credit markets, borrowing costs continue to rise over the intermeeting period. Borrowing costs for residential mortgage loans increased and reached their highest level since 2008. Well, now we're at 2002. It's their highest levels now since 2002. The job is being done there. Credit remained generally available to businesses and households, but high borrowing costs appeared to reduce the demand for credit, resulting in lower financing volumes in some markets. So you're seeing credit drop off, it's because rates are high, not because availability is disappearing, based on what they're saying here. Banks tightened credit standards on commercial and industrial lending for the first time in 2 years, but C&I loans on banks' balance sheets expanded at a strong pace in July and August, reflecting strong demand from non-financial businesses. CRE, that's commercial real estate, CRE loans on banks' balance sheets also continued to grow robustly, but issuance of commercial mortgage-backed securities slowed in July from its strong pace earlier in the year. Again, they're not seeing a lot of stress in the credit markets, so it doesn't appear that there's anything there that's giving them concern that, listen, we see these things going on, maybe we might have to step in and do something. What they're saying is, look, we're driving down this highway and all the lights are green. There's no reason to stop or slow down. Credit availability to small businesses appeared to be tightening somewhat. The share of small firms reporting that it was more difficult to obtain loans continued its upward trend in August, but remained lower than its historical average. Credit in the residential mortgage market remained available for high credit score borrowers. Credit availability for low credit score borrowers continued to ease through July, but remained modestly tight. Where are we now? The volume of rating upgrades. This is interesting. The volume of rating upgrades in the corporate bond market outpaced that of downgrades in July and August. During July and August, there were more upgrades in the corporate bond market than downgrades. The volume of rating downgrades, where are we? Outpaced that of downgrades in July and August, but so far in September, those relative volumes reversed. So in September, we're having downgrades outpacing upgrades. The volume of rating downgrades in the leveraged loan market continued to exceed that of upgrades. Household credit quality stayed broadly solid, but continued to worsen for some types of credit. And down here we have it. Credit card and auto credit delinquency rates rose over the second quarter, particularly among subprime borrowers, with subprime auto loan delinquency rates rebounding notably to slightly above their historical averages. So there is a little something to keep our eye on. What's next here? The staff continued to project that core inflation would step down over the next 2 years. Let's stop right there. Over the next 2 years. When I explained the resetting of rents to market rates, on average, apartments turn over about 30% a year, which means it takes about 3 1/3 years for apartments to completely turn over. And they are expecting core inflation would step down over the next 2 years. So that kind of aligns with how long it takes for rents to reset. And we know that owner's equivalent rent and rent, 32% of the CPI, are very, very sticky components. So this is consistent with understanding how that sticky components can come down. But for some people who were, and I did hear some people on CNBC, not so much on Bloomberg. I didn't hear anyone too much on Bloomberg other than Kathy Wood. Kathy Wood thinks that inflation is going to disappear much faster than what we think and turn into deflation, which I think shows a lack of understanding of how the sticky components in the core work. But maybe she sees some data that I'm not seeing or is interpreting in a way that I'm not interpreting. But there's some people on CNBC saying, oh, inflation's going to melt away to nothing by the end of the year. The Fed is not agreeing with that. Core inflation stepped down over the next 2 years, reflecting the anticipated resolution of supply-demand imbalances and a labor market that was expected to become less tight. So if we're wondering, well, how long? They're saying, look, in our minds, we're thinking 2 years for this to come down. The possibility that a persistent reduction in inflation could require a greater than assumed amount of tightening in financial conditions was viewed by the staff as a salient downside risk to their forecast for real activity. In other words, they said, listen, if we raise rates too high, we could cause real GDP to contract. And they said, yeah, we're aware of that. Right? A persistent reduction in inflation could require a greater than assumed amount of tightening in financial conditions was viewed by the staff as a salient downside risk to their forecast for real activity. Current economic conditions. Recent indicators had pointed to modest growth in spending and production. Job gains had been robust in recent months and the unemployment rate had remained low. Inflation remained elevated, reflecting supply and demand imbalances related to the pandemic, higher food and energy prices, and broader price pressures. Dual mandate. Right? And they threw the other one in here as well, growth in spending and production. So they got some real activity going on in here. They have job gains. So 0.1, everything's good here. Or things are good here. The job gains, things are good here. Inflation, that's bad. Recent indicators of consumer spending and business investment suggested modest increases in these spending categories, but noted that activity in interest rate sensitive sectors weakened appreciably. Several participants noted that the combined strength in the labor market, as well as the data on gross domestic income, raised the possibility that current GDP data could understate the strength in economic activity this year. I got to stop there again. That's an important sentence. When I read that, I thought, oh, okay, you are aware of this then. In a previous market outlook, we looked at, there are two ways that you can look at GDP. Because there is an identity that aggregate expenditure equals aggregate output equals aggregate income. So we can measure GDP in terms of aggregate incomes or we can measure it in terms of aggregate expenditures. When we look at the income approach, we don't see contraction at all. We saw growth in the income approach for GDP. So if you take a weighting, let's say 50% of the expenditure approach with 50% of the GDP approach, we actually had growth in the second quarter over the first quarter, and the first quarter was not negative. This is what they're acknowledging here. Data on gross domestic income. It's saying strength in the labor market, as well as data on gross domestic income, raise the possibility that the current GDP data could understate the strength in economic activity this year. Now, if that's on the table, if that is the thinking, if that is part of the discussion, they are less concerned about downside risks to real GDP than if they were just looking at real GDP data. That's important because I don't think that they're going to be held back by, let's say, third quarter real GDP either being zero or slightly negative. If gross domestic income is showing strength along with the labor market, they're going to look at that and say there's a data anomaly in there somewhere that we can just ignore. Let's look at incomes because that's what people have available to spend. That's what we have to slow down, is the spending side of it. Participants noted that a period of below-trend real GDP growth would help reduce inflationary pressure. They're perfectly willing to accept that. Household sector, consumer spending grew modestly. Spending appeared to have held up relatively well. They're not concerned about that. Business sector, growth in investment spending appeared modest. Manufacturing activity had slowed. Businesses were constrained in undertaking new capital projects as they faced higher financing costs, persistent challenges associated with supply bottlenecks, and hiring difficulties. Participants saw supply bottlenecks as likely continuing for a while longer. We know we're seeing that in the auto sector. We've gotten warnings from Ford already that they're having difficulty with their parts. And a couple commented that constraints on production were increasingly taking the form of labor shortages rather than parts shortages. And honestly, I think that the labor shortage right now is probably the biggest supply and demand imbalance in the economy, is the shortage of labor. And if you combine it with what we saw up here, here is sort of a conundrum that they have. Growth in investment spending appeared modest. Businesses were constrained in undertaking new capital projects as they faced higher financing costs, persistent challenges with supply bottlenecks, and hiring difficulties. You can always fix a labor problem with investment in capital. You can invest in automation, you can invest in robotics, you can invest in AI, but that requires capital spending. And if you're targeting a particular type of capital structure, depending on the level of that capital spending, some debt is going to be involved. While the cost of equity is elevated, the cost of debt is elevated, it looks like it's going to be higher for longer, which means the cost of capital is higher, which then starts to make it difficult to justify new investments. And these new investments could do a lot to fix the supply-demand imbalance in the labor market. So the higher you raise interest rates to try to bring the labor market into balance, the more you discourage investment in labor-reducing capital expenditures or in labor-reducing technologies. This is where the fiscal can step in. So the fiscal could say, for investments made in those particular technologies, we'll allow an acceleration of depreciation in the year that it was purchased. So maybe triple the normal depreciation, even if you're using the half-year rule. So if you buy it in the third quarter and you use the half-year rule, you got a year and a half of depreciation in the first year. That's where the fiscal can step in and use the tax policy to encourage that type of investment in a market in which you have a labor shortage to begin with. And everyone would win because it would allow the Fed or the Fed's job to become easier by bringing that market into balance quicker. But you got midterms coming up. So nobody's going to do anything. And if the Republicans take control of Congress, then you got to do nothing. You got to do nothing government. In which case, even if one party suggested that, no party's going to let the other party get anything. It's all about embarrassing the other party. So we're going it alone. But it's clear that this could help over here with this particular labor shortage issue. What do we got next? Labor market had remained very tight, as evidenced by a historically low unemployment rate, elevated job vacancies and quit rates, a low pace of layoffs, robust employment gains, and high nominal wage growth. Look at this. There's no window of opportunity here for us to say, oh, the Fed's concerned about this. Historically low unemployment rate. Okay, so the job market can handle more. Elevated job vacancies, whole bunch of openings. People are still quitting at a rate of over 4 million per month because they know they can get another job. We've looked at the wage tracker, and job switchers are getting higher pay bumps than job stayers. Low pace of layoffs, it's well below 275, well below that 300. Robust employment gains, high nominal wage growth. What they're saying here is there is no problem in the labor market. That mandate is more than checked off. Employers facing particularly acute labor shortages were those associated with the professional occupations, service industries, skilled trades, and smaller firms. Some market participants noted a number of developments consistent with labor market moving towards better balance. This got my attention. I needed to see this, including a lower rate of job turnover, a moderation in employment growth, and an increase in the labor force participation rate for prime age workers. Well, as we saw in the first week of October, that participation rate nudged the other way. However, several participants assessed that the scope for further improvement in labor force participation was likely limited, especially in view of the sizable contribution that retirements had made to the previous decline in the participation rate. And I think that's right. I think that is probably a very correct statement. Further improvement in labor force participation was likely limited. You would have to solve that with significantly higher levels of immigration And we know right now in the U.S. that is just a political hot potato that nobody wants to do anything about. I know this is long, but I feel that quite a bit of these things are important to know, especially if we're trying to handicap the Fed. And we do have to handicap the Fed. We do have to try to get into their head and say, well, what are you seeing? What are you talking about? What are you thinking? And if I knew that, if I were in the room, maybe I could determine what you're most likely to do. The minutes, the best way of us being in the room, although 3 weeks late. But we're almost done. Participants judged that a softening in the labor market would be needed to ease upward pressure on wages and prices. That's important language. Not that it may have to happen, it would be needed to ease upward pressure on wages and prices. Participants expected that the transition to a softer labor market would be accompanied by an increase in the unemployment rate. Several commented that they considered it likely that the transition would occur primarily through reduced job vacancies and slower job creation. A couple of participants remarked that in light of challenges in hiring, businesses might be less willing to reduce their staffing levels in the event of a weakening in general economic activity. A few participants particularly stressed the high uncertainty associated with the expected future path of the unemployment rate and commented that the unemployment rate could rise by considerably more than in the staff forecast. I think so. That's an important point that they're bringing up, is labor hoarding. Right? Couple remain in light of challenges in hiring. Businesses might be less willing to reduce their staffing levels in the event of a weakening in general economic activity. So that if rate hikes do cause a contraction in economic activity, but businesses hoard labor, and you don't do very much to reduce labor or wage growth, you might not be able to do very much to reduce price inflation if those increases in wages are passed on to price. If they're not, then you're going to have a contraction in margins. So I think this through carefully. I think, well, what are my possible outcomes here? Labor hoarding results in a decrease in margins, which means a lower multiple or a lower price on the stock, or it requires such a deep recession that companies are now forced. They have no choice but to get rid of labor and stop labor hoarding, which leads to a lower multiple and lower earnings. Under both of those scenarios, I get to lower earnings. Participants observed that inflation remained unacceptably high and well above the committee's longer run goal of 2%. Participants commented that the recent inflation data generally had come in above expectations and that, correspondingly, inflation was declining more slowly than they had previously anticipated. So now we know, based on reading this from September, that based on what they saw in the CPI for October, that's not helping. That is the wrong way. They've already used the word here, unacceptably high. Data coming in above expectations. Inflation was declining more slowly. Well, this data point made all those three sentences even more powerful. Several participants noted the continued elevated rates of increase in core goods prices. And in October, when we saw September, October was even higher. These participants considered this development as potentially indicating that the shift of household spending from goods to services might be having a smaller effect on goods prices than they expected, or that the supply bottlenecks and labor shortages were taking longer to be resolved. Participants commented that they expected inflation pressure to persist in the near term. Numerous contributing factors were cited as supporting this view, including labor market tightness, the resulting upward pressure on nominal wages, continuing supply chain disruptions, and the persistent nature of increases in service prices, particularly shelter prices. They are aware of these things. We're going to look at CPI shortly, and we're going to look at the difference between the increase month over month in goods prices at a high level and in services prices. All the inflation came from services. Goods was zero month over month. All of it came from services. But I think they were expecting a bigger drop in goods. Considered, it says here, they noted continued elevated rates of increases in core goods prices. saying here, indicating that the shift of household spending from goods to services might be having a smaller effect on goods prices than they expected. So I think that part of their forecast must have been we will see deflation in goods that will offset some inflation in services. Well, we're not getting deflation in goods. You're getting zero price change month over month, but it's all being shoved over into services. Gradually recede in coming years. Medium term, this is the medium term. Inflation will gradually recede in coming years. In coming years, not months or quarters, years. In assessing inflation expectations, participants noted that longer-term expectations appeared to remain well anchored. Well, that slipped last week. We got two data points, the break-even rates showing increases week over week, and from the consumer sentiment survey. Being well anchored as reflected in the broad range of surveys of households, businesses, and forecasters, as well as measures obtained from financial markets. Participants remarked that the committee's affirmation of its strong commitment to its price stability objective, together with its forceful policy actions, had likely helped keep longer-run inflation expectations anchored. What they're saying here is that, all of that talking we've been doing, hey, it's been working. It's keeping longer-term inflation expectations anchored, so let's keep doing that. I think we can expect that they're going to raise the level of that rhetoric because of last week's move away from that anchor. Some stress that a more prolonged, and this is important, this last sentence here is important, some stressed that a more prolonged period of elevated inflation would increase the risk of inflation expectations becoming unanchored, making it much more costly to bring inflation down. And that's why I wanted to look at the inflation expectations component from the real yields and from the Michigan survey, because they are moving in the wrong direction after the CPI report that week. And when you combine it with that last sentence, a more prolonged period of elevated inflation, well, we got one more month of it, would increase the risk of expectations becoming unanchored, making it much more costly to bring inflation down. That's what they want to avoid. A couple of participants citing higher inflation expectations among some survey respondents as a cause for concern and a reason not to be complacent about longer-term inflation expectations remaining well anchored. So again, those two data points are not going to work well with the Fed. Some participants noted rising labor tensions, a new round of global energy price increases, further disruptions in supply chains, and a larger than expected pass-through of wage increases into price increases as potential shocks that, if they materialized, could compound an already challenging inflation problem. So let's keep our eyes on these risks. Rising labor tensions. I think on Friday or Saturday, my news feed said that one of the Apple stores had voted to unionize. You have a pro-union president that is, right behind them. We know that unions are wage inflationary. No value judgment on that, by the way. I'm just making a statement. They are wage inflationary. Rising labor tensions, a new round of global energy price increases. We're going into what is forecast at this point in North America, at least from what I've heard, forecast to be a colder winter than normal, which would, kind of be fair. Last winter was almost a nothing winter. Like it was, I don't recall too many cold days, and I hardly shoveled at all. I thought, good thing I didn't buy a snowblower. I wouldn't have gotten any value from it. Well, I'm buying one this year. But that would be fair. Energy increases, further disruptions in supply chains, longer than expected pass-through of wage increases into prices. We are almost done here. I think this is our last page to go through here. In their consideration of the appropriate stance of monetary policy, participants concurred that the labor market was very tight and that inflation was far above the committee's 2% inflation objective. So for them, it's a no-brainer here, right? Participants observed that recent indicators of production and spending had pointed to modest growth, while job gains had been robust and the unemployment rate had remained low. Participants reaffirmed their strong commitment to returning inflation to the committee's 2% objective, with many stressing the importance of staying on this course even as the labor market slowed. So yeah, I don't think that a small tick up in unemployment, I don't think that initial jobless claims hitting 240, 245, 250 is going to change their mind. There would have to be a significant change, and in their language they do mention that it must be for a prolonged period of time. The importance of staying on this course even as the labor market slowed. So nobody blink. Participants judged that the committee needed to move to and then maintain a more restrictive policy stance in order to meet the committee's legislative mandate to promote maximum employment and price stability. Move to and then maintain. Many participants indicated that once the policy rate had reached a sufficiently restrictive level, not a restrictive level, a sufficiently restrictive level, it likely would be appropriate to maintain that level for some time until there was compelling evidence that inflation was on course to return to the 2% objective. Now this paragraph I think is interesting. They're not saying that they're going to keep rates elevated until inflation returns to 2%. They're saying they're going to move to a sufficiently restrictive level and maintain that level until there was compelling evidence that inflation was on course to return to the 2% objective. So we could see core inflation go to 5%, 4.5, 4, 3.5. And if you did that over a period of 6 months where it dropped 1.5%, every month we saw a drop. Well, that's compelling evidence. That might be compelling evidence. They might interpret that inflation is on its way to 2%, and then they might start to cut when they saw that occurring. Not once we get to 2%, but the last sentence here, inflation was on course to return to the 2% objective. This is our last paragraph. Most participants remarked that, although some interest-sensitive categories of spending, such as housing and business fixed investment, had already started to respond to the tightening of financial conditions, a sizable portion of economic activity had yet to display much response. Hey, we've raised rates all the way to here. Everyone's saying it's the fastest rate increase they've ever seen, but here's the deal. We see the sizable portion of economic activity has yet to display much response. So you guys are yelling at us for raising rates, but you're not doing anything to change your behavior to tell us that it's too much. That's interesting. They noted also that inflation had not yet responded appreciably to policy tightening, and that a significant reduction in inflation would likely lag that of aggregate demand. So they are aware that it is going to take some time to come down. That's why I think we're near the end of a rate hiking cycle, because they do acknowledge it. Listen, it's going to take a while for it to come down. So once we raise rates, we don't expect it to be a one-for-one relationship that we raise rates and there's an immediate change in behavior. We'll have to raise rates to a certain level, and once we're at that level and we stay there, behavior will slowly change over time, and that will bring inflation down. I thought it was our last paragraph. This is our last paragraph. Notice the yellow highlighting as long as necessary. In light of the broad-based and unacceptably high level of inflation, you got to look at those adjectives, right? It's broad-based, it's unacceptably high. The intermeeting news of higher than expected inflation and upside risks to the inflation outlook. Participants remarked that purposefully moving to a restrictive policy stance in the near term was consistent with risk management considerations. In other words, if we're going to get there, let's front end load all this stuff. Let's get there fast. Let's get there purposely. So what do you think this last inflation report is going to do for November? 75 seems like the base case at this point. Many participants emphasized that the cost of taking too little action to bring down inflation likely outweighed the cost of taking too much action. So they're saying, yeah, if we don't do enough, that's worse than doing too much. So let's do too much. Several participants underlined the need to maintain a restrictive stance for as long as necessary. with a couple of these participants stressing that historical experience demonstrated the danger of prematurely ending periods of tight monetary policy designed to bring down inflation. That last sentence, you know what that reminds me of? Have you ever been in a bad relationship? You know, it was just a bad relationship. All the signs were there. You just didn't pay attention to them, and it was just a bad relationship. It ended badly. It messed you up for a period of time. You know, and then years later, you meet someone else, and all those early signs are still there. Are you going to do too little or too much? Are you going to say, well, let's just see how this plays out, and I'll mention this and I'll mention that, and, you know, but you remember the bad time you had, and it looks like the same thing. You're more likely to say, nope, no way, no, absolutely not. I'm not giving this another day. You're going to end it much faster the second time than you did the first time because you learned your lesson the first time, and the second time looks like the first time, and you didn't like that. It's kind of like what the Fed is in a situation with right now, is they look back at that period of time and they say the vacillating on interest rates, the hike and the pause, the hike and the pause, the hike and the pause, prolonged it longer than it had to be. And in the end, you had to raise rates to such an unbelievable level. You had to crush the economy. Let's not make that mistake again. We see that this is a bad relationship. Let's just end this now. And I think that's sort of where their head is at. All right, let's take a look at CPI. We'll go right to Table 1. Table 1 is really the only, you get a good high-level view at Table 1. And if you want to go deeper into particular types of commodities, different types of goods, different types of services, you can scroll down to the other tables that have a deeper look. But I'll show you a neat table on the Bureau of Labor Statistics site for CPI that allows you to do that graphically. So headline up here, we have unadjusted percent change and adjusted, seasonally adjusted percent change. Unadjusted was 0.2. Adjusted is 0.4, and that is sort of what we're paying attention for. That's headline is 0.4. Why would we not just look at the unadjusted? What's going on here when we adjust? Let's assume that you're in the market for cucumbers, and every month you see some price change in cucumbers. But sometimes cucumbers are in season, sometimes it's harvest month, sometimes it's the month after harvest, sometimes it's out of season. So you'll have price changes due purely to seasonal effects. But it might not tell you anything about the price pressure on cucumbers as a category. So let's just take August being a back-to-school month. And September being, well, now it's over. You buy for back to school, and in September you're back in school. That perhaps from August to September, that whole back in school category, prices on average might drop 0.2% month over month every single year. That's not deflation, that's just a seasonal price change from August to September. But let's say this year it did not drop month over month. Well, then that is price pressure. And you might say, but hang on a second. A pencil last month was $1. A pencil this month is $1. I don't see price pressure. The seasonal effect said that pencil should have been 98 cents. You have to account for the fact that it should have dropped in price because it does every year, but it didn't this year. So there must be some price pressure that kept it from returning to its seasonal price. So once you control for seasonality, the cucumbers in season or out of season, and the pencil being in season based on back to school, or out of season based on September, who's buying pencils now, that's where you get the seasonally adjusted percent change, and that is the number that we look at, 0.4. Let's skip food and energy. By the way, if you look at energy, all big negative signs, and I think that might have been a lure for some people who were looking at this thinking that, well, inflation is going to come in lower. And usually they're citing oil prices are down, gas prices are down, commodity prices are down. And so this will put downward pressure on the price of other things because it's an input to everything else. But that didn't really work that way, did it? If we look at all items less food and energy, 0. The unadjusted was negative 0.3. Negative 0.3 unadjusted. So when you walk into the store, the price you see, you may be looking around going, all of the prices I see, or many of the prices I see, are lower than they were last month. But you're not comparing last month, are you? You have to compare last year and all the other years of September's to August and say, well, what was the normal price drop supposed to be from September to August? What was the seasonal effect in a bunch of these things? And am I ignoring the seasonal effect when I just look at the price? So you went from negative 0.3 to 0 by accounting for seasonality. And that is goods, 0. Month over month, 0. Or if you say, no, let's just look at the actual price you have to pay. Never mind adjusting for the seasonality, it was negative 0.3. All of it was in services. This is services less energy services, read across 0.8. So by the time you weight it, this is 56% of the CPI. This is 21% of the CPI. So by the time you weight it, you get to 0.6 on headline. Shelter, 0.7. And that breaks down into rent, 0.8, and owner's equivalent rent, 0.8, that's 0.7. And then the other categories are weighted lower. The big weighting here, 32%, is in shelter. And that is a sticky component that takes a while to come down. Even looking at the unadjusted price, month over month, 0.7. So very little. If these two numbers are pretty much the same, that means there's no seasonal effect in that number. 0.7 to 0.8. Very little seasonal effect in that number. Then you have some big numbers down here. Transportation services, 1.9. Medical care services, 1%. This is month over month. That 1.9, if you annualize that 1.9, you get to something like 22, 23%. It's a significant number. So it is looking like it's finding its way out of goods. It's finding its way out of energy, but it's finding its way into services. Let's look at a few other things here. Let's go to retail sales. And you can go through the report yourself. We can see that retail sales 0% in September. And this asterisk here, it says here 90% confidence interval includes 0. So remember your level 1 hypotheses testing. If the confidence interval includes 0, you cannot conclude that the number you're looking at is significantly different than 0. That is all that's saying, 0. Now here is where the unadjusted numbers do matter, because companies report unadjusted earnings. So if they have revenue for a 3-month period, they don't seasonally adjust that revenue. That revenue is the revenue they received. It is the unadjusted number. So this drew my attention here. Motor vehicles and parts dealers. The very first one, auto and other motor vehicle dealers. So if I'm looking at not adjusted, I can look at August at 135. Look at the drop into September, 124 on an unadjusted basis. If you look at new car dealers, they just don't break down that 124 into deeper aggregation. So you just have to live with the higher level number, 135 to 124. So I don't know whether third quarter earnings coming out of GM or Ford are going to really beat expectations on this one based on that September. That's a 8.5% drop on an unadjusted number. And again, corporations report unadjusted revenues. Whatever dollar amount happened, that's what they report. They're not seasonally adjusted. You can go through this, and depending on what sectors or what companies you're invested in, you can try to find out what broad category they're in, and you can have a look at the changes, the unadjusted changes month over month on this one. Now, it could be that there is a lot of incentive in August to move vehicles that simply disappears in September, but I don't think so, because as far back as I can remember, when the auto companies were putting their incentives in, it was usually right at the end of September. It's somewhere near the end of September, and it lasts to about mid-November, where you get employee pricing, and all of the discounts were thrown in to move all of the vehicles from last year or last year's model off the lot. So I think there's something else going on here. Okay, that takes care of retail sales. Let's go back to CPI. And this is the landing page if you're looking for the CPI report. And it gives you just a broad chart of what this month looks like. And over here, you can get the PDF. Click over here, you can get charts. There's the first chart we saw. Click on next. This is a rather interesting chart. It goes all the way back to September 2002. And this is all items, but you can overlay it with any of these items over here. So we can overlay it with shelter to see how that behaves. You can get rid of all items and just look at shelter. You can have a look at new vehicles. You can click on, there's food away from home. And it's kind of like the wage growth tracker where you can, look at different time series of the price behavior. If you look at new vehicles here, look at this. This is year over year, right? 13.2, down to in May it was 12.6, 11.4, 10.4, 10.1, 9.4. So base effects are allowing it to come down, and it's peaked in terms of base effects, peaked in April. So if it continues on this particular trend, we could expect by the end of the first quarter for base effects to take care of this, and growth would then be zero, or at least more in line with down here, whether it be some negative, somewhat positive, but getting back to its more mean reverting level. Nice to play with on this one. You can click next and you get different charts here. This is broken down by different geographical regions. The next one here is by metro areas. So there's a lot of interesting charts that you can click on and explore there. And if you want to look at more chart packages, you can click over here and you can get employment, non-employment, pay and benefits. There's some interesting things in there. Productivity, spending and time use, workplace injuries, a lot of neat stuff and charts that are already done for you. All right, some good economic analysis behind us that informs where we think we're going. Let's get to what happened last week. This is a 5-day chart that's up on the screen. And I got a big question mark down here. 8:30, the CPI report came out, and we just sank like a rock until we hit 9:30. We didn't recover at all, or at least the futures and pre-market did not recover at all. Once we hit 9:30, it was off to the races, just completely off to the races. And it was during this hour right here, and that's 1 hour. These are 1 hour bars. It was during that period of time. Sorry, I think those are 2 hour bars. Yeah, those are 2 hour bars. It was during that period of time where I thought, what is going on? Is this a short squeeze all of a sudden? It doesn't seem like it's a short squeeze. The information that came out does not suggest that we're near the end of a rate hiking cycle. In fact, this CPI report tells me that however long you thought the Fed was going to hold rates, add another month on. However high you thought we were going to go, probably another 25 basis points. I'm not understanding this reaction. So because I could find no good fundamental reason why it was doing this, as this was occurring, I was busy selling calls. I sold 340 calls, 350 calls, 360 calls for November, and even went out to December to sell 370 calls because I couldn't find any fundamental justification for this other than, well, maybe there was some algo trading here, maybe we hit a certain level. Maybe it then induced short covering because we know we had like a 20% short interest on SPY. Maybe that was what was going on. I was selling calls. These prices in here are the average price because I would sell a laddered spread 340, 350, 360 all at one time. And then if the market went higher, I would do it again, and then I would do it again, sort of as 3 in a row laddered, so I could get average prices on the way up. So all of my break-evens are sitting right around 370 on these. Anything over 370 would be a problem, and 370 is up here, and I got some 370 calls sold for December. Plus, I also shorted more of SPY. Itself, my average short price was 377. You can see I've diluted it now. My average short price is 372. And then the next morning, I felt pretty good about doing that Thursday. Thursday, the market closed, and I said, okay, well, there we go. I'm good. Friday, the market's going to give all of this back. They're going to go home, think about it, and say, well, that was wrong. And this is what I saw going into the open. I mean, futures at one point were up, almost 45, 50 points. And I thought, what am I missing? Okay, clearly I'm missing something. What am I missing? Because this doesn't make, I would never have bet on this. I wouldn't have even put a probability on a 100 basis point rally on this report that if somebody said, okay, the market is going to recover today, what probability do you place on a 100 basis point rally? I would have put a negative probability on that, saying it is so against what could possibly happen that I have to commit you to some kind of mental asylum for even suggesting it. And that's what happened. Crazy stuff. But then at the end of the day, we sort of, came back in and down we went. Here's the interesting thing. The close, this is all the way to 8 o'clock, by the way, so you have to look at the actual 4 o'clock close. Closed at 357.63. Wednesday, this was Thursday over here. This was Friday. Wednesday's close was 357.07. So unchanged, but look at what we did. All to get to unchanged. You want to talk about roller coasters? That's a roller coaster ride. And we were unchanged from Wednesday night. So on Wednesday night, if somebody had followed the idea of saying, you know what I'm going to do? I'm going to put on a 357 straddle. You had the worst possible outcome if you said, I'm just going to close it on Friday. I close because you closed at 357.63. The straddle didn't pay off. But if you had the 357 straddle, you would have done well closing it out here, putting a 348 on, and then right. But even at 348, I never would have put a straddle on because I wouldn't have expected this. But this is, to me, rather amazing that you basically finished right where you started, that you finished on Friday right where you started, even knowing that this CPI report makes the rate hike going to last at least a month longer and at least 25 basis points higher. And I got the close during the week here. The September 30th close, 357.88, 357.88. And here we are 2 weeks into September, 357.63, 357.07 before. Kind of looks like we're at some kind of support level on this one. So I did a little bit of digging around, and I did find there is a major technical reason why 350 was an important level. So we'll look at that on the next screen. All right, this is the pandemic sell-off, the low that we reached. And I don't know which one to use, so I'm using both. I have the low on a closing basis and the high on a closing basis, and then I have it on an intraday basis. How low did the index reach altogether, and how high did it reach? So if we use a closing basis, we had 22.37. It basically rallied all the way up to 47.96. And if you take a 50% retracement on that on a closing basis, you get to 35.16. If you're using the intraday, 21.91 to 48.18, and take the halfway distance, you get to 35.04. October 13th, the low was hit on the open at 34.93.67. So this is called a Fibonacci retracement, which I think is just ridiculous. The idea that you think that Fibonacci series that exists in a non-strategic environment like nature, which is just a responsive environment, can suddenly show up in strategic environments like social systems. I kind of reject some things from technical analysis, not because I don't understand them, it's just because I think about the analogy that's being used, and I think, how can you possibly think it applies? But anyways, the only reason that I could find is a technical reason, because there was no fundamental reason why. The best fundamental reason I heard was this. If you look at the, and we'll look at, actually, let's wait till the next screen, because I need to show you on the next screen, along with volatility, what the fundamental reason is. But as soon as we bring volatility in, we're back to the technicals, right? But here, I guess I'm going to have to say, if I have to give a reason, it's a technical reason only, is that you had 3,500, which seemed to be the 50% retracement point, and that would create a rally. However, because it's only a technical, if I believe it, if I say, okay, well, I'll accept that it's technical, then I am more convicted that my short position makes a lot of sense. That selling the calls on the SPY as it was going up makes more sense, because it's not fundamentally based. It's only technically based. The fundamentals always show up. And when the fundamentals show up, they always trump the technicals. You can have a chart that's setting up technically very strong, and if the fundamentals show up and they disagree with the technicals are out the window. It's not as if the market says, oh, well, the fundamentals disagree with the technicals. We side with the technicals. No way. The technicals always get thrown out. So it was a key level. There could have been a whole bunch of cover orders at 3,500. There could have been a whole bunch of buy orders at 35. And then when the market popped on the open, that might have started a cascading of short covering, and then a lot of the technical traders saying, see, it worked. Let's lean into this for the day. Let's push it, which forces more short covering, which reaffirms the belief that the technical level held, which forces that into play as well. Yeah, it could be that. I do at this point, if I had to give 50-50 to a fundamental argument or a technical argument, I got to give it to the technical argument because I can't find a good fundamental argument for it. The fundamental argument I have is next. I do want to point one thing out that, as we're selling off here, look at volume. Volume is increasing. So you have volume confirming price direction, which again is a technical indicator. So if our technical indicator is explaining the bounce, you can't then just pick and choose which technical indicators to look at. You have to look at this technical indicator that's saying, but hang on a minute, volume was confirming direction. Okay, what are we looking at here? This over here is a 1-year chart of the VIX, the volatility index. This over here are the last 7 bars of VIX over here, and the purple numbers, that is the last 7 days of SPY, just the price movement in SPY, how many points up or down that it was. Let's just go through this over here, because this last bar is the curious bar. SPY drops 39 points, the VIX closes higher. Next day we drop 105, VIX closes higher. Negative 27, VIX is up. Negative 24, VIX is up. This is consistent. And then you had a drop of negative 11. So the 5 days before the CPI report, we were already dropping. And that is the fundamental argument that's being given, is that, look, all of this stuff was being priced in before the CPI report came out. You've got about 180 points down on the SPY. Was it 105, 144, 54, 71, 81, 91, 95? Over 200 points in the 5 days before the report. 200 points, and then you had another almost 100-point drop on the opening before the market even opened. There's 300 points down in 5 days up to the 9:30 before we open. How much lower do you want to go? So, that argument you listen to, you think, okay, well, I get it. But to have that kind of rally didn't make a lot of sense. To have that kind of rally. Okay, you don't want to go lower than 35. You think, okay, it's all priced in. It came in hotter than expected, by the way. So, okay, maybe not lower, but 100 points up? Come on. Anyways, 92 points up the next day, the VIX closed lower. 86 points back down, the VIX closed lower, not higher. That was interesting. If we look at the 1-year chart of the VIX, you can draw a line at 19 and at 36, and it seems like whenever the VIX gets to 36, it's kind of giving you a signal that you should be buying the market, because you have these very strong rallies from 36. And when volatility drops and complacency enters the market, it might be time to sell the market, because you have these huge sell-offs. When the VIX rises, that's the index going down. Again, here at 19, you have these sell-offs going on. So there's another indicator up here, but this is at 35. Last time it got to 35. It got to 35 here before you had a rally. Got to 35 before you had a small rally. So you combine a VIX at 35 with a Fibonacci retracement at 3,500, and the VIX actually going lower at this point on a Friday, selling off. You're seeing a market that I think the technicals and the fundamentals are kind of coming to the same point, where the technicals are saying you have a double top here. Actually, it's almost a triple top now at 35, and at 35 seems to be a good point for a rally. There's good technical indicator that if you hit a VIX of 35, you buy the index. Well, there's going to be algorithms programmed to do that. You have a Fibonacci retracement at 3,500, and you have the fundamental argument that, look, you were down 300 points by 9:30 a.m. This is 7 days, so basically this is 5 days, and then you have the next morning. The combination of all of that have given up 300 points in front of that report. Yeah, it came in hot, but don't you think 300 points was enough? How much more do you need? So if you combine the two, it almost feels as if the technicals are saying 3,500 held. It's almost as if the fundamentals are saying there's no reason for me to buy any more insurance. I think we're all priced in, which is why if you're not buying insurance, as the market is dropping here, if you're not buying insurance, the VIX is not going up. The VIX came down. Less insurance buying. You have a fundamental argument that seems to make some sense, and you have a technical argument that seems to make some sense. We could see the VIX drop. I don't know if we get all the way down to 25, but we could see the VIX drop. If the VIX drops, well, that's because there's less put buying. There's less buying of insurance. So the implied volatility would drop because there'd be no upward pressure on put prices. Put prices would come out of the, or the premium for the implied volatility would come out of the put prices. That would lower the VIX. We could be set up for a rally over the next 2 weeks if earnings come in as expected or slightly better. And if that's the case, we could lead into a Fed that then moves 75 and then maybe gives us, a nothing day or a slightly down day because maybe 75 is fully expected at that time. Okay, so for the week coming up, I am going to be looking to add some long delta, and I'm going to do that by selling puts. I'm looking at staples, utilities, real estate. There's the XLRE and the IYR. I'm not ready to sell puts on the IYR just yet, but the XLRE, yes I am. XLRE are more large cap REITs as opposed to small cap. And so I have some stats that are down here, and good price points, good fundamental entry points on these as opposed to technical points is the dividend yield. Now these are all what are called defensive sectors except for real estate. Staples and utilities are considered defensive sectors, and I think there might have been some early rotation out of these things because we're going to look at the year-to-date drop and the 1 month drop in them. But a good level to look for is the dividend yield. When the dividend yield gets too high, it means the prices got too low. They reverse very sharply when they get to extreme points. And we can see where the dividend yield is here. It's above most of its points that it's been at in the past. When the dividend yield gets too low, it signifies that the price may be too high. And if we take it from this period of time over here, this does look like a mean reverting series. So the yield on the XLP right now is 2.7%. You can see the dividend payments have grown over time. What I like about doing something like this is that if I am holding XLP, or this does get put to me after selling the puts, I'm holding something that has a 2.7% dividend income versus interest income. So being at a 53% tax rate, all interest for me is taxed at 53%, but dividends are taxed at a lower rate because you have a dividend tax rate, dividend income tax rate, as opposed to interest income. Also, if it gets put to you and you then sell it and create a synthetic. In other words, you don't own it. It gets put to you, fine, you take it, and then you create a synthetic, or you close your option out and create a synthetic. You smuggle the dividend in as a capital gain. Now I have upside, right? And if I do expect that there might be a rally in the market, these sectors will rally as well. But I've sold calls on the market, so I have negative delta. I need to add some long delta, but I want to add long delta in such a way that if there's a rally, great. But if not, I'll still be okay, because these are defensive sectors. SPY is down, 24, 25, 26% year to date. Look at XLP, it's only down 11% year to date. Of that 10.79%, 5.32 was lost in just the last month. XLU is down 11.3% year to date. 17% was lost in just the last month, which means that up until a month ago, XLU was positive. So it's dropped 17.71. And I think there's a confusion when we think about utilities. When energy prices go up, when energy prices go down, the utilities are going down. But that's not how utilities make money. They make money based on their cost plus. Their plus is constant. So they pass through 100% of the cost, and then they mark it up based on what their required rate of return is. Whatever the regulatory required rate of return is, that's what they get. So the sell-off, the 17.7% sell-off in utilities over the last month, to me seems completely undone. Dividend yield of 3.27%. Short interest, 18.25, 13.6, which means if there is a rally in the market and these start to rally up, this short interest could support any upward price movement as well. Not only that, if you have to hold it, you're holding some good dividend yields. XLRE, large cap REITs, 4.6% yield, down 33.3% year to date. In the last month alone, 18% of that came just in the last month alone. 3.4% short interest. I don't expect much help on XLRE, but IYR, which has small caps in there as well. It's got big short interest. It only has a 3.1% yield. I wouldn't be interested in it just yet. Probably in order that I have them here, the two that most interesting to me is XLP and XLU. More so XLP because its dividend yield is at the higher end of its range. So I would be interested in selling puts on XLP, and I'd probably be looking, let me get a better color there, I'd probably be looking for the November at the money puts. The other advantage that these have over bonds is bonds, you're going to get a coupon, right? Unless you have a floating rate coupon, your coupon every month, you know what it is, it's fixed, and then you're going to get principal. But look at these dividend payments, right? The dividend payments increase over time. Bonds don't. Not only do the dividends payments increase over time, but the price at which I buy does not have some maturity amount of some principal. I have potential all over the distribution, including downside as well. I could get negative price return. That's the risk you take when you take on equities. But if you've got a 2-year holding horizon, that 2 years is looking past where I think the Fed is going to be over the next 3 to 6 months. And I think after that, sometime mid next year, I think it will become clear that, okay, we're done hiking. I think now market, wherever the market happens to be, I think that would be a good bottom place. But over the next couple of weeks, we got earnings coming in. We'll take a look at earnings in a second. And the fundamental and the technical arguments both seem to make sense to me. And they both have their own followers and their own believers. And given the price action on the VIX on Friday, even though you had a sell-off, it kind of looks like the market's not too concerned about too much downside. Otherwise, that VIX would have elevated, but it didn't elevate. It actually dropped based on the rally you had the day before, followed by a sell-off, and the VIX dropped on that sell-off day. Well, you can't ignore that. Let's look at the week in earnings. Okay, so this is October 14th, and other than financials reporting this week, there's not much to talk about. So we have more financials next week, along with Tesla, for those of you that are interested in that kind of thing. Let's go down to the earnings forecast. Where are we? Here we are, not the forecast, but the forward earnings. EPS for the year, 222.58 for the current year. Forward 4 quarters is 233.02. That's down from last week. So if you review what last week was, you'll note that is down from last week. This PE ratio of 15.7 is using the index as of the closing on Thursday, being that the index gave back some points on Friday. You'd want to use the closing of the index on Friday. So this is closer to 15 than 15.7. Let's just go down and look at our earnings calendar Look how full it is. This is coming up Monday. Bank of America, Bank of New York, Charles Schwab, more financials coming out, financial services, State Street, Goldman Sachs, and then we start to get into some of the other sectors, Hasbro, Johnson & Johnson, Lockheed, more financials here, Signature Bank, Trustco, JB Hunt for transportation. Netflix will be interesting. They've announced their pricing for the ad-only model, in other words, network TV, $6.99. They've turned into a network, haven't they? They're not going to release the entire series all at one time anymore for any series. They're going to go with week-to-week releases, and you get commercials in between what you're watching. Well, that's what I remember TV to be like. You know, every week at a certain time, you got your new episode out, and there were commercials, and that was free. Let's see, United Airlines, Intuitive Surgical, Las Vegas Sands, still showing negative numbers there. Lots coming up here. Tesla, there's Tesla on Tuesday after the close. Lam Research, for those of you in semiconductors. Anything else? IBM, Prologis. Prologis is a REIT. Big is probably I think the world's largest REIT, heavy into industrials, warehousing, logistics, things like that. Procter and Gamble, Nasdaq. Where else we have anything? Baker Hughes, Abbott Labs. Here is your Thursday. Oh, did I say that Tesla was Tuesday? Sorry, Tesla is Wednesday. This is Wednesday now. Tesla after the close. Anything else? Robert Half, CSX for Rail, American Airlines, AT&T, Poolcorp. I give you one guess as to what Poolcorp sells. See if you can figure it out from the name. Anything else? Freeport-McMoRan. Give us a look into the materials sector, miners, and Schlumberger, American Express. And finally, and that's it. So we got a big week coming up, and then the following week I think is the biggest week for earnings. It's you have the first week, which is light. The second week is heavier. The third week is the heaviest one, with the fourth one usually just as heavy but slightly below that. So a big bulk of earnings will be done before we get the next Fed decision. Let's look at the week ahead, and we'll wrap it up. So as far as the economic calendar, I don't know that there's too much that can really take our focus away from earnings. I think from here, for the next 2 weeks, it's really going to be about earnings, but we got nothing much happening on Monday. On Tuesday, industrial production, I don't expect that to be market moving at all. Looking for the more important things. Canada, we have our inflation rate on, what is this, on the 19th. Let's see if that can give a lift to the Canadian dollar. And every time we think, the Bank of Canada is going to raise rates just as aggressively, the Canadian dollar goes up for like 17 minutes. And then it goes right back down. I for one, am getting tired of that. But it would be nice to see the U.S. dollar, kind of top out around here. And it does. It kind of looks like it might have some resistance at this level. It, I think, tried to break through to new highs, and it didn't going into the end of the week, even as the market was selling off. So that was interesting. As we keep going, I don't see anything here that really can do very much. Continuing jobless claims, initial jobless claims, the forecast is 232. The last was 228. So if we come in 232 or even higher than that, well, then that makes, almost 4 weeks in a row where we've been going. I think it's 4 weeks in a row. Yeah, 4 weeks in a row where we have been inching higher every single week. And I think that's it. Lots of Fed speak, 5 Fed speakers, and going into Friday in the U.S., really nothing going on at all. So the price action next week. There's no economic data, I think, that can either make or break the market at all. I think next week is going to be completely dominated by earnings. Earnings is not the economy. Earnings is the result of what the company has actually done, number one. Number two, accounting policies. As Warren Buffett said, if you can't do it with operations, you do it with accounting. And number three, motivation. No company wants to report bad earnings, so they do what they can to get in good earnings. Tesla already, we already know that they do this. They have this major push at the end of every quarter to try to ship as many vehicles as they can. Work around the clock if you have to, but push into the end of the quarter to make those numbers. Because if you ship it, it's revenue when you ship it. So we know that they manage their operations with an eye to the end of the quarter, with an eye to earnings as well. So does every company. So we have earnings that are developed with accounting policies that have some discretion over what you can get away with, along with a motivated group of people to make sure that they can support the stock price with good earnings. And then, of course, guidance comes into this as well. Generally, we've had growing employment during this whole time period. I don't know that you're going to get earnings that are going to disappoint. If you're going to disappoint, it's going to be on guidance, but I still think it sets it up. Again, supporting the technicals and the fundamentals on this one, it sets it up, I think, for a near-term rally, but a near-term rally, and that's all I would bet on. That's it. I'm going to pass on the quiz this week because I had a house guest for the last 3 days. They left late or early Sunday, but I just didn't have time to really get to this. So I'm already late in the day as it is. The quiz usually adds another half hour onto what I want to do. So I'll add the quiz on to the midweek question and answer. And that's it.